Have you seen the headlines? AI is everywhere. From ChatGPT writing poems to self-driving cars navigating city streets, it feels like we're living in the future. And the money pouring in? It's staggering. We're talking trillions of dollars. But what if I told you that a huge chunk of that investment, maybe even $10 trillion, is built on a house of cards, ready to collapse? Today, we're diving deep into the AI bubble and exploring why a massive correction might be on the horizon. First, let's get one thing straight. AI is a revolutionary technology. It's not a fad. It's already changing industries, from healthcare to finance to entertainment. The potential is real, and the breakthroughs are incredible. That's why big tech companies, venture capitalists, and even governments are throwing unprecedented amounts of money at anything with AI in its name. The problem isn't the technology itself, it's the hype and the valuation surrounding it. This isn't the first time we've seen this movie. Remember the dot-com bubble in the late 90s? The logic was similar. The internet is a game changer, so let's invest in any company with a .com at the end of its name. Pets.com, Webvan. These companies raised millions, even billions, with little more than a good idea and a website. They promised to revolutionize their industries, but when it came time to actually make a profit, the business models just weren't there. The bubble burst, and trillions of dollars in market value vanished almost overnight. The internet was still revolutionary, but the initial valuations were completely disconnected from reality. Now, let's look at AI. The parallels are striking. The current frenzy is fueled by what we call foundational models, or large language models, like the one powering ChatGPT. These are incredibly expensive to build and train. We're talking billions of dollars in computing power, data, and top-tier talent. This has created an arms race, primarily among a handful of tech giants. They are spending fortunes to build the biggest and best models. Investors are seeing this and thinking, this is the new gold rush. They're pouring money into AI startups, hoping to find the next Google or Microsoft. The problem is, many of these startups don't have a clear path to profitability. Their entire business model often boils down to this. We'll use another company's expensive AI model, build a thin layer on top of it, and somehow make money. This is what's known as the application layer problem. Imagine if 1,000 different companies all tried to build a business by simply reselling electricity from the same power plant. How would they differentiate themselves? How many of them would actually survive? Very few. In the AI world, the power plants are the big foundational models from companies like OpenAI, Google, and Anthropic. Many new startups are essentially just fancy resellers of this AI electricity. They might offer a chatbot for lawyers or a content generator for marketers, but under the hood, they're all drawing from the same well. This creates immense competition with very little to set one service apart from another. When your core technology is owned by someone else, your competitive advantage is paper thin. What happens when the company that owns the foundational model decides to offer the same service you do, but better and cheaper? Or what if they raise their prices? Your entire business is at their mercy. This brings us to the second major issue, the monetization puzzle. How do you actually make money from AI? Sure, you can charge a subscription fee, but with so many similar services, there will be a race to the bottom on pricing. Consumers and businesses will only pay for so many AI subscriptions. Think about your own streaming services. How many are you willing to pay for before you start cutting back? It'll be the same for AI tools. Furthermore, the cost of running these AI services is high. Every time a user asks a question or generates an image, it costs the company money in computing power. If your pricing isn't right, you could be losing money on every single user. Many AI companies are currently burning through cash at an alarming rate, subsidized by venture capital. They're chasing growth at all costs, hoping to figure out the profit part later. That's the exact same strategy that led to the dot-com crash. Hope is not a business model. So where does this $10 trillion figure come from? It's an estimate of the total market valuation being projected for the AI industry over the next decade. It includes the skyrocketing stock prices of chip makers like Nvidia, the massive valuations of private AI labs, and the countless startups being funded. The belief is that AI will create trillions in new economic value. And it will. But that value won't be evenly distributed. The likely scenario is that a few massive companies, the ones building the foundational models, will capture the lion's share of the profits. They own the infrastructure, the AI power plants. Everyone else is just renting from them. When investors realize that most of the hundreds of smaller AI companies are not viable long-term businesses, the funding will dry up. Valuations will plummet. This is the correction. This is where that $10 trillion dream could evaporate for a lot of people. Think about the smartphone revolution. Apple and Google built the operating systems, iOS and Android. They created the App Store and the Play Store. They built the core infrastructure. While some app developers became incredibly successful, like the creators of Instagram or TikTok, thousands upon thousands of other apps fizzled out, making little to no money. The vast majority of the wealth was concentrated at the top, with the platform owners. The same pattern is likely to repeat with AI. So, does this mean you should run for the hills and avoid anything related to AI? Not at all. It means you need to be smart and discerning. The AI revolution is real, but the AI bubble is also real. The key is to differentiate between genuine innovation with a solid business model and pure, undiluted hype. The companies that will survive and thrive will be the ones that either build the foundational technology themselves or use AI in a way that creates a deep, defensible moat around their business. They won't just be a thin wrapper around someone else's API. They will integrate AI deeply into their unique products, data, or customer relationships to create something that can't be easily copied. The coming years in AI will be a wild ride. There will be spectacular successes and spectacular failures. Fortunes will be made and fortunes will be lost. As the hype cycle peaks and the inevitable correction occurs, we'll see a shakeout. The companies built on shaky ground will disappear, along with the billions invested in them. But the ones that remain will form the bedrock of our new AI-powered economy. The technology is here to stay, but the $10 trillion question is, who will actually be left standing to profit from it? Thanks for watching. If you found this breakdown interesting, make sure to hit that like button and subscribe for more deep dives into the tech world. Let me know your thoughts in the comments below. Do you think we're in an AI bubble? I'd love to hear your take. See you in the next video.